Hello traders, Lance Ippolito here for the free video. Let's get to a rundown of what's driving the volatility in the market and some of the from junk bonds to international markets to the S&P to the QQQs. Try to do it briefly too for the free video. So when we were having our February decline here, what caused this decline here? I'm looking at HYG. So HYG is high yield. So if we overlay, let's say, for example, high yield, let's quick compare with right here to the SPX, we see this relationship to where, back in October, we actually had high yield decline, the SPX ride, but normally they move 1-to-1 correlated. So we have here, the start of February, high yield sell-off, which was the first tail, and then we had the S&P sell-off, and you can see even with our bounces, high yield bounces, S&P bounces, high yield sells off, S&P sells off. So what we had here recently was high yield selling off, S&P selling off as well. So what you can do even for an intraday guide is maybe something like on the 15-minute look and see, hey, if high yield starts to sell off like we had yesterday afternoon, I mean, look at this. This is a perfect relationship. The S&P sold off. So that's what I'll be keeping an eye on today. J&K, the Barclays junk bond too, pretty similar relationship as well. They pretty much move at the same ratio. But a couple things I do not like, let's take the S&P off here, is when I'm looking at emerging markets, EEM, for example, we had the false breakout here, and here we are in emerging markets selling off very hard the past 2 days. When we look at the SPY, remember, we were looking at that January level where all of retail got in. So what happened was we had the sell-off, we went from up on the year to now retail being negative here, panic mode, to where we actually took out the January open here on some decent volume, traded up, and then we started to fade back down. On light volume, you could tell this consolidation here, consolidation box. And my thing with this was I felt like the retail investors and traders shouldn't get a free lunch. There's no free lunch to financial markets. So if we just made this bounce here and a V recovery back to new highs, those people, they basically get a free ride. The market shouldn't be that easy, especially for retail. So what happened is we consolidated, then we had the breakout here where we took out the previous day's high. It looked like, if we look at this from the past 2 days, this looks like a clear bull breakout. Consolidation, breakout. We did have light volume on the breakout, which was a little concerning. I know Thursday and Friday we had light volume of last week, but this looks very bullish, like we could retest the highs here. So it trapped a lot of people, and then we obviously see the past 2 days with yesterday's afternoon sell-off with the Fed speaker, which is approaching today too. So that's a little bit of worrisome. If we look at the QQQs, they made that clear recovery, which, at the time too, I was thinking the S&P could follow. But if I look at something, my favorite leader to look at out of the indexes is micro caps, the IWC. Now, it doesn't trade a lot of volume, but the IWC had a nasty 2-day sell-off. Even the consolidation phase was not very pretty with these large wicks of these sell wicks on these candles here. So that was a little concerning to me. And then if you look at the Russell 2000, which makes up a lot of small caps and mostly regional banks, and the Russell sold off hard, especially yesterday on volume, where it actually took out these longs. So on this candle here, where we had a clear breakout, took out these longs, they got stopped out. That's why we had the volume flush there to the downside. So looking at the Russell, I think if the Russell, the IWM, for example, retests this 145 to 143, we shall see if that holds. Now, I'm not trying to call a top or a bottom in the market, but I will make note, the bond market yesterday finally had a green day. We'll see what bonds do here in TLT. We are at support. We'll see if we break down. I know everyone's calling for a bear market there. I think the best thing to do is kind of sit tight, be patient. If you're used to trading, buying options, like buying calls, and the market is trending, everything's going good like it was in January, It's not that type of environment anymore. So you're having a lot of theta decay, especially if you're buying out the money options, and you're buying a lot of volatility with the VIX over 20 again. So it's not the market we had in January. So just keep that clear, because for traders, you have to adapt to the current situation. If it's selling premium, if it's doing more neutral strategies, or if it's even, if you're not into that, you're more directional, it's even sitting on your hands or taking down your size. That is something you can also do. Remember, your cost of trading is very minimal a day. What do you pay? Platform fees, just your time. Commissions are so cheap nowadays. It's not like every day you have to go out there and make, trades and trades and trades. Sometimes the greatest thing to do, sit on your hands, go out for lunch, be an observer of the markets. You don't necessarily have to participate every day. Remember that.